In today's video, we're going to take a look at the Amplify CWP Enhanced Dividend Income ETF, ticker symbol DIVO. This is the 20th video that's a part of my portfolio series where I'm doing an in-depth analysis on all 32 stocks currently in my own portfolio. If you're new to my channel, my primary focus is on income investing and also dividend growth investing with holdings that offer at least a 4% yield. As I'll say in every video in this series, this isn't done in any particular order, so just because this video is 20th in this series does not mean that this is my 20th favorite fund or my 20th largest holding. Also note that because I own all these holdings, I am biased towards them, so do your own research before making any investment decision for yourself. Also, let me know if there's any improvements to this series that I can make going forward. Feel free to check out last week's video, which was on Medical Properties Trust, ticker symbol MPW, which I believe has long-term upside potential after I was able to buy in near the bottom. Going into my Vanguard account, which is where I do all my dividend investing, as of the making of this video, I currently own 58.157 shares of DIVO. Their fund pays monthly dividends, with their last being for 14.81 cents per share. With the number of shares that I own of this fund, I receive roughly $8.61 a month from this ETF. DIVO is an actively managed ETF of high-quality, large-cap companies with a history of dividend growth along with a tactical covered call strategy on its individual stocks. DIVO is strategically designed to offer high levels of total return on a risk-adjusted basis. This ETF pursues income from two different sources, which are the dividend-paying stocks that it holds and by opportunistically writing covered calls on these stocks. DIVO also aims to be less volatile than the overall market. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. DIVO was launched back in 2016 by Amplify ETFs, and it's also the company's most popular ETF based on assets under management. DIVO is currently the third lowest yielding investment in my portfolio. As of the making of this video, this ETF only offers a dividend yield of roughly 4.83%. But this fund is one of my investments that I'm relying on for long-term growth. It's a covered call fund that's been able to grow both in share price and dividend distributions over time. Additionally, the dividends that they pay are also more tax advantaged than a lot of other holdings I have in my portfolio. For those pursuing a covered call strategy, DIVO in my opinion is a solid fund worthy of consideration that'll provide you with some additional long-term growth. So let's go ahead and take a deeper look inside this ETF and see what it offers. To give a general overview of this ETF, we'll start by looking at how Amplify describes this fund. It says, DIVO is an actively managed ETF of high-quality, large-cap companies with a history of dividend growth along with a tactical covered call strategy on its individual stocks. DIVO is strategically designed to offer high levels of total return on a risk-adjusted basis. So for starters, this ETF is actively managed, meaning that a portfolio manager or managers hand-select everything that goes into this fund. One of the downsides to actively managed funds is that they usually charge higher expense ratios than passively managed investments. From what I could find, the average expense ratio of an actively managed ETF is roughly 69 basis points. According to Amplify's website, DIVO's expense ratio is 55 basis points, meaning that it's quite a bit lower than average for an actively managed investment. It's actually one of the cheapest covered call funds that I've come across, which is another positive for this fund. When I consider the consistent growth both in share price and dividends that this fund has been able to deliver, I'm not really too discouraged at all by this expense ratio. I think it's pretty reasonable given what I get from this fund. If we look at the holdings inside this ETF, we can see that it only has 25 stocks as of the making of this video. This fund's website lays out the process the management team goes through when picking DIVO's holdings. First, they target large cap growth stocks that have been able to deliver consistent growth and dividends over time. If we look at some of the fund's holdings, you can see that it's full of stocks that have long track records of consistent dividend growth. For example, their current largest holding as of the making of this video is Visa, who have been able to grow their dividends for more than a decade so far. Their second largest holding is Procter & Gamble, ticker symbol PG, who've been able to grow their dividends for more than 6 decades and counting. So DIVO likes to hold these really steady, more consistent kinds of investments. The second step in their stock selection process is making sure that the holdings are well balanced across different sectors. If we look at their sector allocation as of June 30th, we can see they're very well balanced across different industries. No sector currently makes up more than 17% of their overall portfolio, which considering the fact they only hold 25 stocks, I think is pretty impressive. Funds that target these higher yielding types of investments are usually overly allocated into financial, real estate, or energy stocks, so this is a pretty good balance. The third step is actually selecting the securities. It says DIVO consists of 20 to 25 stocks, which are screened and adjusted according to attributes including market cap, management track record, earnings, cash flow, and return on equity. Then finally, once they have their portfolio, their last step involves tactical covered call writing on the individual stocks to conservatively boost the income generated by the portfolio's record. According to Amplify, it says, the fund strategy seeks to provide gross annual income approximately 2 to 3% of the dividend income and 2 to 4% from option premiums. So at most, the highest dividend yield you could expect from this ETF could be up to 7%. The process that DIVO goes through in picking their investments I think is pretty solid. We can see this ETF only invests in larger, well-known established companies with strong financials and superior long-term performance. It's basically a fund that holds some of the largest companies in the world that offer dividends. That alone would appeal to investors who might not even be interested in pursuing dividend holdings. But what makes things even better for people who are pursuing income is the fact that not only does it pass on the dividends it collects, but DIVO actually follows a covered call strategy. This increases the monthly dividends even more and basically increases the dividends from the types of safer dividend stocks that offer very low yields. If we look at the share price performance of DIVO since its IPO, you can see it's had a really good amount of growth for a covered call fund. For those who are pursuing this style of investing, DIVO is a good way of diversifying your covered call portfolio to include something that might not yield as much as, say, QILD, but can offer much greater long-term share price appreciation. If we look at the total return of DIVO since its IPO, it's seen an average annual return of 11.07%, which is great. In a little over 6.5 years, an investment made in this ETF would have more than doubled in value with a total return of 101.89%. That's assuming that dividends were being reinvested into buying more shares of this fund each month. According to this fund's description, it says that DIVO aims to be less volatile than the market, meaning that DIVO's share price shouldn't swing as much as the average fund in the market does. To see how effective this ETF strategy is at being less volatile, we'll have to look at its beta. For stocks and ETFs, beta is a measure of volatility, so if a stock has a beta of 1, it means it moves perfectly with the market. If it's less than 1, it means that it swings less than the market, and if it's more than 1, then it means it swings more. According to Yahoo Finance, DIVO's beta over the last 5 years has averaged 0.74, meaning that it's quite a bit less volatile than the overall market and makes it a little safer. But a downside to this though is that when the market is performing well, it shouldn't be expected for DIVO to perform just as well as the market. This is because of the covered call strategy that this fund uses, along with the fact that this ETF just doesn't hold any fast-growing companies. This fund selects typically older companies to go inside of it with solid financials and cash flow. Procter & Gamble and Visa aren't going to grow at the same rate as Nvidia, so DIVO isn't going to perform nearly as well in terms of share price when there's a market rally. But remember, it does offer a much higher dividend yield on safer stocks that pays monthly. Another benefit to DIVO is that this ETF pays large amounts of dividends that aren't taxed as ordinary income. Unlike most BDCs, REITs, and closed-end funds who pay distributions that are taxed at your normal income tax bracket, DIVO pays a mixture of qualified, non-qualified dividends, and return of capital. On this fund's website, we can see that there's a tax section. On this page, you'll want to click on the 2022 Primary Layout Report, which gives the classification of every dividend this ETF paid in 2022. Looking at DIVO's dividend history, we can see that last year they paid a mixture of different distribution types that'll save you money on taxes during tax season. To summarize, DIVO's a covered call fund that's a more conservative option for people seeking income. It's a dividend holding that holds safer investments and I think would be a solid pick whether you're a covered call investor or just a regular dividend investor. This fund's stable holding should ensure that this ETF should continue to grow and won't experience any significant dividend cuts. Amplify also launched an alternative to DIVO that holds international stocks, which is ticker IDVO. So far this one has been pretty solid too, so this might be worth considering if you're looking for an international holding. But with that being said, that's going to conclude today's look at DIVO. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. You'll also have the option of reading this analysis as well as every other analysis that I do in this series. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.